Well, welcome to today's Hammond Iles Financial Power Hour. Today we're talking about the one big beautiful bill and going over some of the key highlights and what they mean to you. So we're grateful for you taking some time to join us today at our webinar, or if you're watching this video later. Thank you for taking the time to join us. Hammond Iles Wealth Advisors is a registered investment advisor, and as such, we do not provide tax or legal advice. So we encourage you, as we share this information, that if something catches your eye or if you want to know exactly how it applies to your personal tax situation, we encourage you to reach out to your own tax or legal professional. We will be having some time at the end of today's webinar for questions. So as we go through today's material, you can enter those questions into the chat, or at the end, you can raise your virtual hand and ask your question. If you're watching the video today and would like to submit a question, you can email that to us at hello@hiwealth.com, and we'd be happy to answer your questions. Now, the one big beautiful bill, or OBBBA, for simplicity's sake today, I'm going to refer to it as OBA, rather than repeating the title over and over and over again. It was signed into law on July 4th, and it stacks up about 870 pages long. So it literally was focused on extending and modifying many of the provisions of the Tax Act that was passed back in 2017, the Tax Cuts and Jobs Act, or you'll see the abbreviation TCJA throughout today's presentation. And there are a mix of permanent changes, temporary benefits, and new deductions that we want to make sure that you're aware of. And we'll go through those in that order through our presentation today. And this is going to impact your taxes as well as your retirement income and your charitable planning. But there are a few other things that I just wanted to bring to your attention today. As I mentioned, it's a very big bill, 870 pages approximately. And so today we're not going to go over everything in the bill. This is not a marathon. We are going to hit some of the highlights. And the reason for that also is this bill, just being passed a little over a month ago, still has to be finalized through the details and regulations that will be issued by the Internal Revenue Service. So until some of these aspects are fleshed out in complete detail, there may be some changes. So if you're watching this video later in the year or further into the future, I encourage you to revisit some of these topics that may have adjusted. But keep in mind, this bill is law and will be law until the next tax law is passed. Also, I want to apologize in advance for these slides in today's presentation. They're very text heavy because I wanted to get a lot of bullet points into the presentation to share as much useful information as possible with you. I want you to know that we will be sharing with you a copy of all of the slides. So when we email you the link to the recording of this webinar, we'll also attach a copy of all the slides, so you don't have to take tremendous amount of detailed notes, but you may want to jot down your questions as we go through. If you're watching this webinar as a video and you would like to have a copy of those slides, just send us an email at hello@hiwealth.com and we'll be happy to share the slides with you. Also, I encourage you to talk with your tax preparer or accountant. Each of us has a unique situation with our own personal taxes. So although we'll be talking in general terms today, to find out exactly how they apply to you, I would encourage you to talk to your tax and legal profession. Now, going on, as we talk about this one big, beautiful bill, or OBA, I want to remind you that the beauty is in the eye of the beholder. So today, I'm not going to talk politics. I'm not going to talk about the positives or minuses of this tax act. I'm just here to share the truth and the information with you of what's included in it. As I was thinking about the beauty of this bill, I was thinking of this optical illusion that is common, that if you look at it, do you see the young woman with her head turned, or do you see the older woman with a more pronounced nose and chin? No matter how you look at it, and you may see both if you look at it long enough, there are different perspectives on what this picture is of. And the same holds true with the OBA Tax Act, in that the beauty is in the eye of the beholder. So we'll take a look at each of these aspects and see how it may impact you and your financial picture. So first, we're going to start with the permanent changes. One of the main goals of the OBA Act is to extend or make permanent many of the changes that were implemented in 2017 in the Tax Cut and Jobs Act. That act put into place new tax brackets and a variety of other tax changes, but had a sunset provision to them. If Congress had not taken action this year, that sunset provision would have caused all of our tax policies to revert back to the 2017 level before that act was passed. But now, with the passage of OBA, some of those changes have been permanently put in place and will remain permanent until there may be a future tax act. Say that 10 times, tax act. So the first and major goal of this bill was to cement and make permanent the income tax brackets. So the 7 tax brackets that were established in the Tax Cuts and Jobs Act in 2017, that 10%, 12%, 22, 24, 35, 32, 35, and 37, those 7 tax brackets are now permanent. So until we have a new tax law, those will remain the same. There's no sunset provision. So for one aspect, for tax planning, this makes it a little bit easier because we at least know where the tax brackets will be for the coming future. All of these brackets, as they are with income, will be indexed for inflation. So the dollar amounts for each of these brackets will adjust year over year. So we have the 2025 income tax brackets on the screen now. One of the interesting things as part of OBA is that they added an additional provision related to the 10% and 12% tax brackets that will kick in when they adjust the brackets for 2026. So each year there is a base year and it's adjusted for inflation. And what this provision talks about is that in 2026, when they make the next adjustment for the 10% and 12% brackets, they will be using 2016, or the inflation rate before the last tax act, as the starting point for those tax brackets. So those two will get a larger adjustment for inflation than the upper tax brackets. Now, that will ultimately impact all of us. So when you think about tax brackets, I like to think of it similar to a water fountain that my wife and I have on our porch. It pumps up water into a top that then trickles down into a next lower bracket that fills up and then triples down to the next bracket until it goes all the way down and then gets pumped back up. So when you think about your taxation in tax brackets, it functions the same way. We all pay tax at the 10% level. And if we fill up that bucket, we move on to the next bracket and pay the next amount of taxable income at the 12% rate. And then if we fill up that bucket, we move on to the 22% and so on. So by the tax brackets in the 10 and 12% level being expanded, that in essence impacts all of us as taxpayers, that we all will have the benefit in 2026 of having a larger tax bracket at the 10% and 12% level. It's for the 10%, it's only a few $100s. It's a little bit more than that for the 12%, at least what's being projected at this point. But it won't be sizable, but it will have an impact. Now, the second thing that was made permanent are the standard deductions. One of the goals of the 2017 Tax Cuts and Jobs Act was to simplify the tax code. And they did that by eliminating some things, such as some itemized deductions and exemptions, and increase the standard deduction to make it a little easier that more and more taxpayers, rather than going through and having to record different transactions and tax receipts, you could kind of push those aside knowing that you just took the standard deduction. So for this year, under OBA, the standard deductions become permanent, and they are permanently increased up to the levels that you see here of the $15,750 for single and $31,500 for married filing jointly. The other aspect that is made permanent is the estate tax exemption. And so although that has been creeping up with the index for inflation, it has now been bumped up for next year. This year, just under $14 million per person can be passed on to the next generation or family members without any estate tax. For a married couple, twice that amount. And next year, they'll bump it up a little bit more and start off with an even amount of $15 million per person and $30 million per couple. So most of us probably won't have some estate tax to worry about. And after 2026, that amount will continue to index for inflation. So it's really the top 1% or less than 1% of Americans that will be impacted by estate taxes. Now, one of the things that was restored and made permanent is they brought back the mortgage insurance deduction. So for homeowners with an FHA or a VA loan that put down less than 20% down on a house, so you say you put down 10%, or I mean, back in the heyday of the 2000s, you could put down a lot less. If you put down less than 20%, you're required to have mortgage insurance, against default on your loan. And now the OBA restores the deductibility of those mortgage insurance premiums. So that deduction was made permanent starting next year in 2026. So now individuals will be able to deduct that on their tax return in addition to mortgage interest. Now, one of the other things that's made permanent is that they made new eligible expenses for 529 plans. If you're not familiar with 529 plans, it's commonly thought of as an education savings account. And they are, for the most part, state-run. Each state typically has its own 529 plan. So depending on what state you're joining us from, your individual state has its own plan. Now, you're not required to use your own state plan, but there can be some tax incentives to use your own state's tax return, 529 plan. So for me, for example, in Connecticut, you can deduct up to $5,000 per person. So for a married couple, that's $10,000 for contributions into the Connecticut 529 plan on my state income tax return. So there may be some benefits through using a plan. Now, when we think of a 529 plan, it was originally created to have the ability to help parents and family members save to support kids and their education. Initially, it was just for higher education like college and universities. With the Tax Act in 2017, that was broadened to include elementary and secondary schools. And now they've expanded the expenses that can be deducted out of a 529 plan even more. The way that the 529 plan works is that you put a contribution in, and unless you're in a state, as I mentioned, that gives you a tax deduction, there's no tax benefit typically on putting money in. But that money grows tax deferred. So if you have a young grandchild or a child and you can contribute to that, that money grows inside the 529 plan tax deferred with no taxes on the interest and earnings that it has over the years that it's in the account. And then when funds are withdrawn from that 529 plan for education purposes, it comes out tax-free. So now they've continued to expand those eligible expenses that you can take money out of the 529 plan tax-free. So now they've expanded the list of K through 12 expenses. Currently in 2025, you can deduct up to $10,000 to pay tuition for your primary or secondary school. So if you're sending your child to a private school, you have the ability of tapping into a 529 plan to pay that tuition. But now, as of July 4th of 2025, OBA is adding the additional expenses, whether you have public, private, or even homeschool expenses. So if you're homeschooling and you have curriculum or textbooks, or even in college having textbooks or other aspects of having some curriculum that you may need to purchase, tutoring outside the home. Now, that doesn't mean that you have to physically be outside the home, but that the tutor is not a family member. You can't, sorry, mom and dad, you can't deduct for tutoring your own child. But if you hire a tutor outside your home and they meet certain qualifications, you can take that out of a 529 plan, standardized testing. And one of the nice things is some additional costs that parents and families that are dealing with students with disabilities now are able to be deducted from a 529 plan as well. Now, the aggregate of these new deductions is around $10,000 a year this year in 2025, and then starting next year, that'll expand that you can take out up to $20,000 a year out of your 529 plan for these expenses without any tax consequences. Now, one of the other things that they added to 529 eligible expenses is new post-secondary credential expenses. So when you're looking to incur expenses to attain or maintain an eligible credential, you can take out those expenses out of a 529 plan. So Mary, yes, you can take funds out of your 529 plan if you have one for your CFP or your Certified Financial Planner. It also includes continuing education. So for me to maintain my Certified Public Accountant designation or my Certified Financial Planner designation, which both require continuing education every year, I could potentially use a 529 plan. So now it starts to turn the table, and that now you don't only have to think of a 529 plan as something for young children or something that has to be used up before they graduate from college. It's something that can be used for credentials after college and throughout life. So it may be something that I might be interested in going back and opening a 529 plan for myself to run those expenses for my continuing education through. So it opens up a wider basket of those that may look at 529 plans as something to be part of your financial picture. If you have questions about that, certainly reach out to our office and talk to a financial coach. We'll be happy to talk to you more about 529 plans. So there are some additional permanent changes. One that has been temporarily put in place and now is permanent is that mortgage interest debt or your mortgage is limited to $750,000. So what that means is that if you have a mortgage on $1 million house and your mortgage balance is over $750,000, the amount of interest that you can deduct on your taxes only applies to $750,000. So that is locked in and is permanent going forward. Also, the child tax credit is now permanently increased to $2,200 per child, and that will increase for inflation starting next year in 2026. The portion of that is refundable, so if you have a low amount of taxable income, there is part of this credit that could be refunded back to you if you're in that situation, and that is limited to $1,700. But there are phase outs. So for single or head of household, once you cross over $200,000 of adjusted gross income, it starts to phase out. as well as married couples over $400,000. And I just want to pause right here and say this is one of the reasons why I recommend talking to your accountant or a tax professional. You will see as we go through today's presentation that a number of these different deductions or credits have phase outs of income. And so it's important that when we look at things, for example, possibly doing a Roth IRA conversion where we're converting our IRA to a Roth IRA, which triggers additional taxable income on that portion that we're converting, we have to make sure that when that gets entered in, that we're not also rippling through some of these phase outs that impacts our taxes more than we anticipated. So it's always helpful before moving forward with anything like that that impacts your taxes to have a conversation with your accountant. A couple of other additional permanent changes is that miscellaneous itemized deductions are permanently repealed. Now, this was certain expenses, like, for example, investment management fees on non-retirement accounts, that could be deducted if your itemized or miscellaneous deductions exceeded 2% of your adjusted gross income. We don't charge that much for investment management fees, so our fees are never deductible. But if you had other miscellaneous deductions, it could be taken into effect. But going forward, that's no longer the case. So you don't have to worry about gathering that information if you've gathered it in the past. However, one of the miscellaneous deductions that used to be important, especially for educators, is that they could take a deduction for anything that they paid out of pocket for different supplies or things that they used to teach or coach individuals. So now, although miscellaneous itemized deductions are permanently repealed, they added a new deduction for educator expenses, and that will also be able to be deducted as an itemized deduction in 2026. Now, also related to itemized deductions is starting next year in 2026, taxpayers in the highest tax bracket, 37%, will face a cap on how much they can have in itemized deductions. Basically, their itemized deductions will be no more than 35% of their adjusted gross income. So we've talked about permanent. Those are the things that are made permanent. Now we're going to talk about some things that are temporary. So although they try to avoid certainly things that would phase out over time, there are part of OBA that are now for specific periods of time between 2026 and 2029. So we'll go over those. So that means that either Congress will need to take action before it expires or it'll revert back. And one of those examples is what's called the SALT deduction or the state and local tax deduction. Now, part of the 2017 Tax Act was that the SALT deductions, your ability to deduct your property and state income taxes on your federal income tax return, was capped at 10% or $10,000. Now, as part of OBA, that $10,000 cap is temporarily increased to $40,000. No matter what type of a filer you are, single head of household or married jointly, there is a $40,000 cap now for property taxes, and that will go up at 1% per year between 2026 and 2029, and then it sunsets. In 2030, it reverts back to the $10,000. So trying to make some senators and congressmen happy. They wanted to boost the SALT cap, especially for states where we have higher property taxes. And so now you'll be able to deduct more of that on your taxes potentially. Now, for high income earners, again, there is what they call a phase down, that this deduction will phase down from the $40,000 down to $10,000 if you exceed the levels of adjusted gross income. And for those of you that may be small business owners, there's still no restrictions on state level pass-through entity taxes. So if you have a partnership or a limited liability company, the way that that works is rather than making estimated payments for your state tax through your personal Social Security number. It actually gets made through your business, and then through your business K-1 that gets sent to you, it gets reported and deducted. So thankfully for business owners, that's outside of this cap, and that continues going forward. Now, one of the interesting things, and I'm not sure why this was put into the bill, but there will be, starting next year, a floor on charitable giving. Now, you may be used to this if you have recorded and maintained your medical expenses. If you itemize your tax deductions, medical expenses are only deductible above 7.5% of your adjusted gross income. So now, starting in 2026, there's going to be a floor for charitable giving to be itemized on your tax return. There will be a floor of 0.5% of your adjusted gross income before your charitable giving becomes deductible. And I'll go over some examples for you in just a minute. But charitable deductions are still subject to AGI, or adjusted gross income limits. So for example, for cash donations, you can deduct up to 60% of your adjusted gross income. If you're donating appreciated or non-cash contributions, whether that's your old clothing that you're donating to Goodwill or another nonprofit, or whether you're donating appreciated stock to a charity, that is limited to 30% of your adjusted gross income. So that stays in place, and the new floor is applied before the AGI limits come into account. Now, any amount subtracted for the floor does not carry forward unless you have excess above the AGI base limits. So it's a lot to keep track of. So here's just one example on what that might look like to give you some insight for charitable giving. So here's Sue. Sue has an adjusted gross income of $100,000, and she donates $20,000 of appreciated stock to a public charity. So her new charitable floor, again starting in 2026, is 0.5% of her adjusted gross income, or $500. So when we look at her potential charitable deduction, it's the market value of that appreciated stock, or $20,000, minus that $500. So she could potentially deduct $19,500. Now, for appreciated stock, that AGI limit is 30%. So it's 30% of her 100,000, which is 30,000, and her gift is underneath that. So she can deduct the full $19,500. So because she can deduct that full amount, there's no charitable donation carry forward. So if you donate more than that AGI charitable deduction limit, it can carry forward for you. So that brings me to example number 2. David, same scenario, $100,000 of adjusted gross income, although he's donating $40,000 of appreciated stock to his favorite charity. Now, again, with his charitable floor, 0.5% of $100,000 is $500. So he could potentially deduct $39,500. However, his AGI charitable deduction limit is at $30,000, 30% times $100,000. So his $39,500 is more than that. So he can only deduct on the 2026 tax return $30,000. Now, he doesn't lose out on the amount that he was given above that, so that carries forward. But the interesting thing is that because he exceeded that AGI limit, that floor comes back into the picture. So now he has a $10,000 amount that carries forward. So it makes calculating charitable giving a little bit more complex. But one of the things that I would point out is if you make an annual gift in January of every year, for example, this year you may want to consider backing that up and making that donation in 2025 when you won't be subject to the charitable floor. Now, if you don't itemize your taxes, this is kind of a moot point. You just take the standard deduction. There's no tax consequences of your charitable giving. But if you do itemize, that's something that you might want to plan for. Now, we're going to talk about what they call below the line deductions. I mentioned earlier that in 2017, that tax act, the Tax Cuts and Jobs Act, was passed to simplify taxes, why they raised the standard deduction so that they could eliminate some of the individual itemized deductions. Well, guess what? They're back. We have 5 new below the line deductions that now come back into play that you'll have to keep track of again. So much for simplifying it. Now we're making it a little bit more complex. So you just want to be aware of these things so that you can make sure that you track some of these expenses if you want to deduct some of them. But starting off, what do I mean by below the line deduction? And talk a little bit about the advantages or disadvantage. So when we think about above the line or below the line that you need to start with is your adjusted gross income. So anything that is deducted before adjusted gross income is above the line, and anything that is deducted after your adjusted gross income is calculated is considered below the line. So above the line, those are things that are deducted, such as taxation on Social Security benefits and this new 0.5% floor on charitable giving. Below the line deductions are after AGI, so it reduces your taxable income still, but does not reduce your adjusted gross income. So when you think of below the line, it's not going to impact the taxation of your Social Security. It's not going to impact your charitable giving floor because it's below the line. So they do have a tax benefit to you that they reduce your taxable income, but your adjusted gross income isn't impacted. Now, also the other thing about this is even if you're taking a standard deduction, these below the line deductions are still available to you whether you itemize or not. So OBA creates 5 new below the line deductions, and just to visually show you on where that is on the 1040. Now certainly now with these new below the line deductions, they'll have to figure out how they're going to fit this on the page again. But again, when we talk about the line is the adjusted gross income, or on 2024's form, line 11. So above the line deductions are those things above, like in the adjustments in line 10, that are deducted before adjusted gross income. And below the line deductions are those things that are deducted underneath that before you calculate your taxable income. So that's the above the line and below the line. So we have 5 new below the line deductions to take a look at. Now the first is our new seniors deduction. Now I was somewhat surprised when I got my AARP card when I turned 50, but now I have something new to look forward to. Now, once I get to 65, which is still several years away, hopefully if it's still around when I get there, it will be an additional deduction. Now, the interesting thing is there already is a senior's deduction on your taxes for those age 65 and older, or if you're blind. This is in addition to that. It's an additional $6,000 per person, or $12,000 for joint filers if both spouses are above the age of 65. And there is a phase out. So again, you have to be aware of that. So this deduction phases out for that modified adjusted gross income. And when we say modified, it's basically adding back in things like tax exempt interest. So you can sort of think of it just as your adjusted gross income for most people. So if you're over $75,000 as an individual or $150,000 as a joint, this deduction will phase out. Again, it's below the line, and so it doesn't reduce the adjusted gross income. Otherwise, that would be kind of a cycle to try to figure out your adjusted gross income on whether you could deduct this. So just to give you a visual picture of what this looks like, for 2025, for a single individual, you can deduct $15,750 for your standard deduction, and you can take a $2,000 age 65 plus or blind deduction. Now you'll be able to add an additional $6,000 on top of that, so your total deductions could be $23,750. Now, for married spouses filing jointly, depending on if you have one spouse or both spouses over age 65, you can see that you'll be able to deduct around $39,100 or $46,700. Now, one of the planning aspects that I want to highlight here while we're talking about this additional deduction is if you were thinking about possibly converting some of your IRA to Roth IRA, which would trigger taxable income to you, this may be an opportunity to recognize some income and have it offset by this new deduction if you're over the age of 65. So that is a possible planning depending on where your adjusted gross income is. So something to think about as you think about Roth IRA conversions. Now, one of the things I want to say right now that has been talked about in the press and by some politicians is that nobody's going to pay tax on Social Security because of this. Well, the key here is Social Security is still taxable. Now, you may have the deduction for seniors that may offset some of your Social Security benefits being taxable, but it does not eliminate the taxation on Social Security. The standard rules for the taxation of Social Security still apply, and the way that that's calculated is that it looks at your provisional income, which is your adjusted gross income, plus tax-exempt interest, plus 50% of your Social Security benefits. If that provisional income is over an amount, whether you're single or joint, then 50% or 85% of your Social Security becomes taxable. Keep in mind that the senior deduction is below the line, so it does not impact your adjusted gross income, so it's not going to reduce that calculation or your provisional income that's used in the calculation of Social Security taxation. So just be aware of that if you read online or see that this new tax act eliminates tax on Social Security, that may or may not be true in your situation. Now, one of the other interesting things on a below-line deduction is they've added back a charitable deduction. They've restored the deduction for non-itemizers starting in 2026. The CARES Act back in 2020, it temporarily added the ability for individuals to deduct up to $300 and a married couple up to $600 of cash donations to a charity if you didn't itemize on your taxes. Well, now that expired in 2021, but they brought it back with OBA and it has made it permanent. It restores the charitable deduction for non-itemizers. So even if you take the standard deduction, you're still going to get a benefit for your charitable giving on your income taxes. Now, the limit on that is $1,000 for single filers and $2,000 for joint filers. Now, keep in mind also that has to be in cash, and it is not subject to that 0.5% floor that we talked about. That floor only applies if you're itemizing. This, if you donate a $1,000 check to your favorite charity or charities, you can deduct that. But keep in mind, if you have a donor-advised fund, which will be a subject for a future Power Hour, you cannot get this deduction for making donations to your donor-advised fund. This is directly to a public or private charity, a 501c3. Now, something that's been talked a lot about that is now a below the line is the no tax on tips deduction. So again, depending on the news that you're reading, this can be bigger than it may actually be. So I wanted to clarify exactly if you happen to be in a job that collects tips or know someone who is, you can understand on kind of how this applies. So again, it's a below the line deduction available to all taxpayers, even if you itemize between 2025 and 2028. So this is another thing that phases out unless Congress takes action. Now, the deduction is up to $25,000 for all filers, no matter your filing status. and the deduction is reduced $100 for every $1,000 that your adjusted gross income is above the limits, whether that's 150,000 for single filers or 300,000 for joint filers. Now, some of the requirements is that it has to be an occupation that traditionally and customarily receives tips before 2025. So you should not see all of a sudden everybody putting a tip jar out. So when you're going to the store, or even though many stores have tip jars out now, but even though places that you haven't seen tips before all of a sudden start putting tips out to get this tax-free treatment, it doesn't work. There will be a list determined by the IRS exactly what professions they can apply to, and tips must be voluntary, so it can't be part of an automatic service where they just automatically add it to your bill, and it must not be earned through a specified service, trade, or business. So for financial advisors, accountants, attorneys, there is a specified list, and those people were out of luck. Sorry, you can tip me all you want, but I just can't deduct it on my taxes. So those will be outside the purview of that deduction. Now, our next below the line deduction is no tax on overtime. So this is for workers who earn overtime. And again, it's below the line deduction, so it's available to all taxpayers, even if you itemize. And again, it's in that same little window, 2025 to 2028. So if Congress takes no action, this will go away after that time frame. Now for this, it is dependent on your filing status. So you can deduct up to $12,500 for a single filer and up to $25,000 for joint filers. There also is a phase out, $100 per thousand over those ranges. And the way that the deduction applies is that it's the amount of overtime over your standard and normal rate of pay. So if you earn $20 an hour and you get paid $30 an hour when you work overtime, the amount that is eligible for the deduction is only that $10 difference. You can't deduct the full $30 overtime pay, only the difference between your ordinary pay rate and the overtime rate. So have to get out some pencils and a calculator and do some real math on this with some paychecks if you have overtime. Now, I want to also point out here as a warning, just because taxes on your overtime and tips may be deductible, it doesn't mean that the tips and overtime are exempt from payroll taxes. They're still included in your adjusted gross income, and they can potentially be subject to state income tax. So although this may be a benefit to those that are in a profession or a job that has tips and overtime, they just need to be aware of the fact that you're still going to pay payroll tax on the whole amount of your tips and the whole amount of your overtime, even though some of it may be tax deductible. Now, another one that they brought back is auto loan deduction. So now there's a temporary deduction for auto loan interest, again in that same window, 2025 to 2028. If you saw our monthly email, we talked about this in our recent month, and you can deduct up to $10,000 of interest on a new passenger vehicle for new loans that are taken out in 2025 and going forward. Now, there are some requirements. The car must be brand new, so if you're buying used, I'm sorry, but your auto loan interest is not deductible. And it has to be assembled here in the U.S. and used for personal use. So if you have a car for business use, doesn't count. And again, there are phase outs depending on your income range. Again, this is a below the line, so it can be taken whether you itemize your deductions or not. So if you have a new car loan or you're looking to buy a new car, this may be a factor to play into your decision making as to which car you choose on whether it's been assembled here in the United States. So that talks about our below the line deductions. And now one of the new things that has been introduced through OBA are what are called Trump accounts. So this is a new way of starting to save for young people for their retirement. It's a new savings account option for children. Normally with Roth IRAs and traditional IRAs, you have to have earned income to be able to make a contribution to the account. So for most children, if they were going to put money away for retirement, they'd have to wait until age 16 or older until they have earned income. These accounts, though, can start as long as you have a Social Security card and you're a U.S. citizen. So the rules before the year that you turn 18 is that starting next year in July, so the accounts aren't available now. It'll take some time for investment companies to put these together, is that you'll be able to contribute up to $5,000 per year, and that contribution limit will be indexed for inflation, and it's not deductible. So you put $5,000 in, there's no tax deduction or anything about that. And there's also that there's no earned income. So grandchild, 1 year old, you could open a Trump account and put $5,000 into it. Now, interesting thing is that it's not just you or family members that can contribute to a Trump account. The federal, state, or local governments, and interesting enough, they included charitable organizations can also contribute to your child's account. Now, when they do contribute, that doesn't count towards that $5,000. So you can put $5,000 in, and potentially the federal government could put money in. Now, also putting money in, employers can add to it, and they can add up to $2,500 per year. Now, this amount, though, does count towards that annual contribution level. So if you are lucky enough to have an employer that offers a benefit that we're going to contribute to your child's Trump account, they'll put $2,500 in. So now that counts towards the $5,000. You can only put $2,500 in for yourself. And that limit will be adjusted for inflation. And they have mentioned that even though the accounts aren't available yet, that any child born in the United States between 2025 and 2028 will be eligible for the federal government giving you a little boost or start into the Trump account by $1,000. So once those accounts are open, you can open it if you have a newborn and apply. And certainly those details will still need to be finalized as to where you apply. But you need to apply or opt in to claim that credit to be able to get that $1,000. So those details are still being worked out. So I don't know exactly how that will work. But if you have a newborn or expecting a grandchild or something, not pets, has to be a child. If you're expecting a grandchild or having your own children in the next few years, you could open a Trump account. Now, contributions, one of the things is it'll be excluded from the beneficiary's income. So the beneficiary is the child who benefits from the account. So if you put $5,000 in, that's not going to count as income for them. They just get the benefit of getting that in the account. So it goes into the account. So now what? How does it work? Well, now it gets to grow. So before the age of 18, investments in Trump accounts are limited to U.S. equity index funds, and market cap indexes such as like a U.S. small cap fund are allowed, but sector indices are not. So you can't invest in a AI sector fund or a technology fund or healthcare fund. It has to be a general market index like the Standard & Poor's 500 index or the general small cap index or mid cap index. And those funds that are in the account can't be leveraged, meaning that they're not taking on debt or leveraging the assets, taking on risk within the portfolio. And they have to have annual expenses no larger than 0.1%. So after age 18, then those shackles come off, and the 18-year-old or whoever's working with them can now invest the funds in any way allowed that is typically allowed in an individual retirement account. Now, within the account, no distributions are allowed before age 18, but after age 18, the account takes on IRA-like distribution rules with the early withdrawal penalty, like an IRA. So if you take money out before age 59 and a half, there will be a 10% early withdrawal penalty. Otherwise, if you let it stay in there all the way until age 60, then you can take money out. Now, the interesting thing is that this is going to be an accounting nightmare for investment firms, because the direct family contributions, even though you don't get any tax benefit when that money goes in, it's considered after-tax money, just like a Roth IRA contribution. So it will come back out tax-free. However, any other entities like government or nonprofit or employer contributions, those contributions and all the earnings and growth will come out as pre-tax. So you'll pay tax on that amount when those amounts come out. So it's kind of a hybrid between a Roth IRA and a traditional IRA. Contributions not taxable when they come out, but all the growth and interest will be taxed when it comes out. So this may be a way of setting aside money for kids and having it grow tax deferred over their lifetimes, getting a head start on retirement savings. Certainly, in my opinion, when they get old enough and have earned income, you're going to be better off putting money into a Roth IRA where both the contributions and the interest and growth comes out tax-free. But this will be something that we'll be looking at as they come online and we get more information. At this point, there's a lot of rules that need to be set up. One of the things we don't know, will these accounts be subject to required minimum distributions like an IRA? Will it be subject to the same 10-year payout rule as an IRA has under the Secure Act? So there's a lot of things that still need to be defined. Now, one of the things that I wanted to add, and because there are a lot of things, and I know we're getting close to the end of our hour, is that there is a repeal of all the clean energy credits. So if you are planning to buy an electric vehicle, if you're planning to do home improvements to your home that involve clean energy, you want to be aware of this chart and know these deadlines. So for a clean vehicle credit, so for an electronic vehicle, that vehicle must be acquired before the end of September. So you'll want to get out and start looking if you haven't already done that. Alternative fuel property, again, property must be placed in service by mid next year. For energy efficient home improvement credits, that needs to be put in place by the end of this year. And then the clean energy credit, where you get 30% of solar panels or geothermal or wind power, that property must be paid for by the end of December of this year. So all of these are being phased out very quickly. They were originally, when they were put in place, were intended to go out to years 2030 to 2034. So that's been drastically shortened. But again, this is one tax law. It could be changed in the future, but if you want to take advantage of these credits now, you want to take action before the end of the year. So that was a whiz-bang quick review of a lot of things in the OBA Act that was just passed last month. There are many other things that could impact you that are in there. There's smaller, different things that we didn't have time to put in today's presentation, but today we covered the highlights and the ways that those will impact you. Again, I encourage you to talk to your tax accountant or tax professional on how they may impact you directly. If you have questions about any of the types of investment accounts that we mentioned today, whether that's 529 plans or eventually the Trump accounts or other strategies like Roth IRA conversions, reach out to our office. Our contact information here is on the screen. You can always send us an email at hello@hiwealth.com, and you can go to our website and schedule a free complimentary conversation if you're not already a client of Hammond Iles.